Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last lecture, we used the RSI to measure the ratio of gaining days to losing days. Today, we're looking at momentum from a completely different mathematical perspective. We're going to calculate exactly where today's closing price sits relative to its absolute highest high and lowest low. This is the KDJ indicator, also known as the Stochastic Oscillator. It is one of the most sensitive reactive timing tools in quantitative finance. The KDJ is built on Raw Stochastic Value, or RSV. It takes today's close, subtracts the lowest low, and divides it by the total high-low range. Let's look at the trading app. If you want to see the KDJ, you just click the indicator and you find KDJ here. Then you can see a separate window below the K lines. So you can make it a little bit large. And we can see three lines, K, D, and J. And if you look at the setting, uh, we can see the parameters are strictly 9, 3, and 3. Why? A 9-day look back captures exactly 2 trading weeks, a complete short-term market cycle. The 3-day smoothing filters out random daily noise without introducing the severe lag of a large moving average. Let's get back to the lecture and the math definitions. Because the KDJ is so incredibly sensitive, it is easily manipulated on small stocks. Look at the denominator of the formula again. High minus low. On a tiny penny stock, one large buy order can spike the price, permanently breaking that high-low range. This is why in the US stock market, your target asset must have a minimum market cap of $20 billion. Ideally, we want assets over $50 billion. It takes massive, genuine institutional liquidity to move the math on a mega cap stock. Because this indicator is bounded between 0 and 100, we have strict extreme zooms. K over 90 and D over 80 is overbought. But I wanted to warn you about a mathematical phenomenon called indicator blotting. Look at this chart of Tesla in July 2024. Notice that I have completely hidden the J line, so we can focus on the core data. The K line goes above 90, okay, the orange one, and the D line goes above 80. Retail traders see this and immediately short the stock around here. But look at the price. The stock price just keeps violently climbing for several consecutive days. The indicator is splatted. It is pinned to the ceiling. The stock price eventually decreases, yes, but only after the momentum officially breaks and the lines across downward. This chart is the ultimate proof that an overbought reading is a warning light, not a blind trigger to short sell. You must wait for the structural breakdown. And here is another remark for the J line. If you see that J line blast above 100 for 3 consecutive days, the stock is repeatedly closing at the absolute ceiling of its 9-day range. The trend has gone parabolic. Do not chase it, but absolutely do not short it. The rubber band is pinned. You must wait for the lines to physically cross down before betting against a trend this strong. The primary buy signal for this indicator is the golden cross. When the fast K line crosses up and over the slow D line. But I want to share the statistical reality with you. Proven by extensive algorithmic backtesting, if you blend by every KDJ golden cross, your win rate is basically a coin flip, about 50%. Furthermore, if you try to short a death cross during a massive macro uptrend, your win rate is less than 50%. Because in a bull market, institutions always buy the dip. So, to trade like a quant, you have to optimize the math. We only buy a golden cross if it happens deep in oversold territory, when K is below 30. We want to see the volume expanding, and most importantly, we want dual confirmation. The ultimate way to trade the KDJ is to combine it with Bollinger Bands. Look at this chart for NVIDIA. The price drops and perfectly tests the structural support of the lower Bollinger Band. At the exact same time, down below, the KDJ prints a beautiful golden cross in oversold territory, right here. This mathematically proves that structural support is holding exactly as momentum is surging. By requiring this confidence, algorithmic models push the success probability to 65% or higher. And you can see that the price goes higher. And statistically, we have about 65%. That is how a sniper trades. That's all for today's lecture. See you in the quant lab.